Well, hey there, everyone. Welcome to Chart This with Dave Keller. It's Thursday, June 12th. I'm your host, Dave Keller, coming to you from a kind of chilly Redmond, Washington. We're here in mid-June. I got a sweater on. It's highs like 60 degrees or something crazy. We're back to spring, fall weather here, which is, it happens. This area of the country, to be honest with you, it's volatile, but overall, happy to be with you and hope you guys are doing well wherever you're tuning in from. Choppy session here, but overall kind of a positive one, right? We can see that the S&P, as we'll look at in a minute, moved higher and bounced off of almost 6,000 in yesterday's session to back almost to 60.50. So we're continuing to see a bounce. We've made it now through 2 trading days, really juiced with inflation data before the open. Market saying things are good. Market saying things are okay. Kind of a very defensive sector at the top of the list, and half of the top sectors were not growthy offense. They were more defensive sectors. So I don't know if all is well when you've got utilities, healthcare, staples, and real estate all doing pretty well compared to other sectors. But for what it is, the market remains innocent until proven guilty. I would say still innocent. We'll see what happens here. Let's get to the market recap and see how things played out using the best practices of technical analysis. I can see questions and comments coming in on the various platforms upon which we're streaming: Facebook, LinkedIn, YouTube, and X. I appreciate you guys tuning in live. Those that are doing so, please ask questions as they come up as you go through. We'll take a question or two at the end of the episode. Anything we don't get to, we'll put it in the mailbag. I will be flying to Boston during the day tomorrow, but planning an all mailbag episode once I get squared away in the hotel. Tomorrow afternoon, tomorrow evening. So look for that later in the day. Let's look at the charts here. So S&P 500 finishing higher 0.4%. We'll call the close 60.45 and change. The Dow up about 0.25%. The NASDAQ up almost an identical amount, 0.25%. Mid caps basically flat for the day. Small caps down 0.4%. The VIX moving higher. It's actually at an 18 handle, right? So it means 18 point something, just slightly above the 18 level. So VIX below 20 tells me don't be too worried about market volatility. VIX above 20 tells me to start paying attention to signs of excess volatility, signs of rampant fear, because that's how sudden downtrends tend to begin. So we're getting closer and closer. We're edging up toward that level. So this is one of those days, which doesn't happen often, but definitely happens, where the market moves higher and the volatility increases as well. There's usually kind of an inverse relationship to that, with the market higher and volatility lower, or the opposite. Market moves lower on higher volatility, but there are days when they can move together. The heightened volatility, particularly if we get above 20, it's not an end of the world reading necessarily, but definitely tells me to be a little more cautious, because excessive volatility can, that's basically how waterfall declines can start, as an initial spike higher in volatility. Looking at interest rates, I had a great interview earlier today with Jay Hatfield. Jay's the Chief Investment Officer at Infrastructure Capital Advisors. Smart guy with a fantastic process. Loves to talk about what people like the Fed and others are getting totally wrong. Loves to point out how a lot of economic analysis is meaningless, in his humble opinion. I'm paraphrasing Jay. Sorry for that. But backs it up with great data. It says, look, we've looked at the data and here's what we think is important. And we talked about interest rates. We talked about the Fed. We talked about, in his opinion, why the Fed will probably be way too late in lowering rates, and that he would agree that rates should be lower than they are right at this point. We should have that interview ready for you probably tomorrow morning, so keep an eye peeled for that one. While you're there on my YouTube channel, make sure you check out the last episode with George Noble. Legendary investor and opinionated person with some fantastic lessons learned working with some very successful investors, having a pretty decent career in his own right as well. So a lot of good momentum there in the podcast. A lot of great guests lined up here in June into July. I'm excited to share some of those conversations with you as well. Jay and I talked about rates in particular. Rates coming down today, right? So the 10-year yield finished around 435, 436. The long bond yield just above 4.8%. The 5-year point now below 4%, down around 396. So we're seeing rates start to come down a little bit. I did grab the chart of the $TNX, which is the 10-year Treasury yield, which we'll look at here in a few moments. But overall, I would say weaker rates at this point I mean, not great, right? Because I would say at this point in the cycle, you have stocks that have been rallying, you have bonds that have been pulling back, which sort of implies a risk on. Things are good. People are putting money in risk assets like equities, like cryptocurrencies. That's pretty good. If we would start to see a rotation away from stocks and into bonds, away from growth stocks and into defensive sectors, these are the kind of rotations that could tell us that trend is starting to change. And I think rising rates in this context would start to mean, falling rates, right? If rates would come down and bond prices would start to go up, that could indicate that investors are moving more toward kind of safe haven positioning. Higher rates just tend to mean optimism, right? And optimism for future economic growth. Because if we're all bulled up on the growth of the economy, we probably don't want to own bonds. We're going to own equities and other things that have the potential to thrive during a growing economy. But if we're concerned about future economic growth, we probably buy bonds and we probably push rates lower. And that's why I think that's an important one to watch right about now. So one day only, but the chart of the 10-year yield has started to break some trendline support, which we'll look at here in a moment. The dollar index down about 2/3, 0.75%, we'll call it. This is using the UUP here as a proxy for the U.S. dollar. Another one to pay attention to, of course, because if a lot of non-U.S. investors start rotating to U.S. dollars to buy U.S. assets, dollar index should be going up more than we've seen here, as the dollar's making new lows at this particular moment. Commodities kind of a choppy sideways session, but in the end, the DBC was basically flat for the day. Gold and silver did manage to move higher, as did copper. The GLD up 1.25%. That is a holding that I have among these ETFs. Crude oil slightly higher. Energy has been one of the top performing ETFs out of the 11 sectors. A lot of days recently. Today, actually more down the leaderboard, and with crude oil prices, taking a bit of a breather after an incredible rally, pushing to new swing highs. Cryptocurrencies all in the red today, right? You can see Bitcoin down over 2%, Ether prices down over 4%. Bitcoin's currently around 106,300. That's down from 110,000 as we were doing the show yesterday, talking about that pullback, that initial pullback from 110,000. So, this is an interesting one. Even though equities were sort of flat, slightly higher, you see cryptocurrencies, which are, arguably more of a speculative asset than equities, really starting to deteriorate through the course of the day and accelerating lower here in the last 6 hours or so. All right, shall we look at the 11 S&P sectors? Sector breadth, not bad. You can see 8 out of the 11 S&P sectors finished higher. Utilities at the top of the list, 1.2%. Technology, number 2, up 0.9%. Healthcare, number 3, up 0.8%. The top 5 sectors on today's leaderboard, 4 of those 5 are the 4 defensive sectors, right? From utilities to real estate. Technology is kind of the outlier there, and has been driven higher by a lot of different parts of the technology space, particularly semiconductors and others, which have done quite well in recent weeks. So technology number 2, but the rest of the top of the leaderboard, pretty defensive stuff. On the bottom, you have the 2 other FANG sectors, the XLC, communication services, down 0.8%, consumer discretionary, the XLY, down 0.5%, and industrials down a 0.25%. So yeah, I mean, this is one day only. I always hopefully don't say this too much, but as a friendly reminder, make short-term decisions using short-term data. Make long-term decisions using long-term data. So I would hesitate to use the context of this daily sort of market recap and make long-term decisions based on that one-day move. But a series of days where you see defensive sectors thriving like this, that would start to get me worried. One day is not enough to be worried about, I don't think. But if you start to see more evidence of rotation away from the growthy stuff that's been leading off of the April lows, and certainly been leading in June, into the defensive stuff that was leading kind of a second half of May and is kind of cooled off a little bit. If we see more of that rotation, I would start to be concerned about the sustainability of the gains that we've seen so far in 2025. All right, let's look at the breadth conditions here, kind of all over the place. You've got like a stoplight sort of effect here. If you look at the breadth in the S&P, pretty good. 60% stocks up, 40% of stocks down. You look at small caps, it's the opposite, 2/3 down and 1/3 up. So 2-to-1 ratio decliners over advancers. So depending on what part of the market you look at today, you get a very different reading in terms of the breadth conditions. The New York Composite Index, which is as close as I have, sort of a broad universe that I think is important to follow. A little more positive than negative, but not by a significant amount. You can see these are still shaded, kind of neutral amber. So not overwhelmingly positive readings here today. That's another, I think, big question mark for this market. The breadth has improved so far in the month of June as the markets have moved higher, and the breadth conditions have been overall pretty supportive after being sort of weakening in late May. June so far has seen stronger breadth conditions, particularly on short-term breadth readings like the McClellan oscillator pushing back above the zero level. Today, not so much. And I think that's the danger to this market, the risk for this market. When you think about what charts, what evidence would tell you that the great party we've experienced off of the April 7th low is the music has stopped and we want to start to, make some changes to a portfolio that's maybe all bulled up. I would say breadth deterioration, momentum deterioration, prices breaking down. Those are obvious things to look at. Breadth is a little harder to detect unless you have a diligent process or a consistent process of breaking down breadth readings. All right, we can see the Magnificent Seven stocks are actually quite mixed today, about half up, half down. NVIDIA having a strong day, and you can see the 4 top stocks in this list are the 4 technology members, right? NVIDIA and other semiconductors continue to push to the long side, up 1.5%. Microsoft, which has turned more, I feel like it keeps doing pretty well, and all of a sudden doing pretty well for a long period of time. Now, all of a sudden, it just looks like a really good chart, up 1.3%. Now, I think you have to say Microsoft probably one of the strongest of this basket of names. And then Broadcom, which had pulled back, dropped below trendline support, now reverting back to the upside this week, up 1.25%. Apple, which is arguably one of the worst stocks within this basket, actually up 0.2% after earlier this week. Disappointment, I would say, overall for my read on the WWDC. I've seen a number of reviews. Again, this is not scientific. This is more anecdotal evidence, a la Humphrey Neal, looking at contrary evidence. But a lot of the commentary and reviews that I've seen from technologists is that the liquid glass not as good, not as easy to read. Just not quite ready yet. We'll see. We'll see what happens. But for now, the stock moving, not going down, moving higher by 0.2%. Tesla continuing to struggle, down 2.25%. That's after the robo-taxi announcements earlier this week. Alphabet down 0.9%. That's a key one because it's actively testing its 200-day moving average. Netflix slightly lower as well. By the way, we don't look a lot at the Dow Industries. I have this up on my dashboard as well because I think it's just super helpful at any point to just look at what's moving at the group level, at the industry level. I'm not a huge fan of the Dow industry groups because there's not a lot of transparency in terms of how they're calculated. I like things that I understand in terms of the guts of the index, what it's doing. I've not been able to, have a lot of, I've not been able to look at the members and constituents, and I'm not as much of a fan of price-weighted indexes. So I don't use them as much. However, it is helpful as just an initial kind of check what's working on a day like today. And if you look at what's working, gold stocks, number one. Another group that I'm seeing on here, financials, right? Insurance brokers, mortgage finance. These are some of the top 10 groups in the U.S. markets today. Also defense, which has been struggling here a bit as of late. All right, let's go to the market carpet, a heat map style visualization. As you may be able to tell, by the way, I am in the stock charts office, which means things are all in just a slightly different place. Hopefully I'm doing okay. I do feel like I'm kind of figuring things out here. But bear with me. If it takes me a second, because everything's just in a slightly different position. If you're trading and you trade with a set of screens that looks certain way, and then you try to trade at a different setup with screens that are playing, you just feel like nothing is where it needs to be. That I'm having that moment, but I think we're okay. All right, let's look at the heat map again. I love this sort of visualization just to allow us to go big picture to small picture, macro to micro, which is how I like to approach the markets with any sort of consistent approach. When you look at the heat map today, very mixed, right? There are things that are up, and I'm particularly noticing some of the big growth names, particularly on the left side of the screen. Those are the technology names, Microsoft and NVIDIA. 4 out of the top 5 technology stocks, Microsoft, NVIDIA, Broadcom, Oracle, which is up 13% on earnings today, That's certainly getting it done. And if you're wondering why technology is so high on the leaderboard, Oracle doing what it did as the fifth largest name in the ETF, that's certainly helping. But besides Apple, which was up slightly, everything else in that sector in terms of the leading names, pretty good. But when you look down further, not as strong, right? So some of the semiconductors like KLAC, what else is on there? Micron, they're not down a lot. They're just not up as much, right? They're sort of taking a bit of a breather. So something certainly to keep an eye on. In the industrial sector, Boeing obviously reeling from yet another, disaster in aviation, it pains me to see headlines like that. But an Air India flight going down en route to London right after takeoff. That was a 787 Dreamliner. That's not great for Boeing. And the stock's down, almost 5% today on that news. GE, which is the biggest weight in the industrial sector, down, but also some of the defense names in there like Raytheon, RTX, and others pulling back here. Airlines generally kind of moving a little bit lower today. You can see Southwest is one of the worst performers in the industrial sector today as well. Elsewhere, a lot of green in some of the defensive sectors, particularly utilities, right? Utilities ended up being the top performer today. CEG, VST, both having really good updates. The average stock in that sector did pretty well today. In this sort of environment, again, I think it pays to think like a contrarian. I'm a trend follower by training, right? So my goal is to follow uptrends as long as they persist. And I'm certainly going to not stop doing that anytime soon. But once you've established that the uptrend is in play, which I think it is, it's all about determining what would tell you that something's different, right? What would you need to see to tell you that uptrend is no longer happening? I think one of the biggest risks to this market here, besides things we mentioned earlier, like breadth deterioration, will be leadership rotation, right? Things like utilities, REITs, staples, healthcare doing better than they have. These are sectors that have been lagging. Healthcare may be a bit of an outlier because you've had some biotech names and others that have actually done pretty well. But in those others, right, utilities and REITs, these have been lagging sectors here, and especially coming out of the April low. And so I think the rally that we've seen has more and more been driven back by the classic growth trade that worked so well in 2024: semiconductors, technology, software companies, etc., cloud computing names. At some point, those assets start to rotate into defensive sectors. I think that is a warning sign to look for. I'm not seeing that yet, but a day like today reminds me of how important of a signal that can be. Not a lot to be excited about in the communication services sector. In fact, very few of the S&P members in that sector were up. It starts with the biggest names: Alphabet, Meta, Netflix, not down a ton, but not up. It gets to entertainment names like Disney pulling back a little bit. Maybe early on, some of those charts have actually looked pretty good here for a little while, but I would keep an eye on that sector as well. I think that's it. Healthcare looking better than it has in a while also. Let's celebrate that. Some of these charts are pretty ugly chart. United Healthcare is not a good chart. I don't care what it does today. It's still in a primary downtrend. I would much rather, Merck is still trying to break out of a long-term downtrend that's been in place for over a year. I'm more excited about charts like Gilead, which, again, have pulled back a little bit, but still you would argue that the long-term trend has been quite strong from mid-2024 to now mid-2025. It's been a good 12 months for Gilead. Now, March to April was not great, but now we've recovered that, right? And we've regained a good amount. We've actually gotten back up to this swing high from early April before the tariffs were announced. I'd love to see it get above that level, but I would say the momentum we've been building here is pretty encouraging. A breakout on stronger volume with an RSI pushing above 60, that would be the sweet spot. That would be the ideal outcome here. That's the kind of thing I'd be looking at as a potential trigger, but not quite happening yet. But I'm much more interested in those kind of names in terms of my approach than something that's been just on a disastrous downtrend for 12 months and it's just starting to turn higher. Now, if that's more your game, healthcare is a great place to look because there are a number of those charts that have been long-term losers that are starting to rotate higher here. Days like today, maybe making that more and more of a possibility. All right, let's look at some charts together. I'll take some questions. We'll be done, and then I need to go get a haircut. I don't know if you can tell from the camera shot, but sorely needed here. We got to prioritize. We used to call that an intraday haircut in my Bloomberg days if you jump out in the middle of the day. So I waited till after the close and after the show, but but still something that needs to happen. Here's the daily chart of the S&P 500. If you look, I mean, generally, we've talked about the stoplight approach: green light, yellow light, red light. I think anything above 5750 to 5800 is a green light. I kind of stand by that general assessment. I wouldn't be surprised if we have some noise here over the next week, just because we've had a pretty low volatility kind of classic uptrend phase in the month of June. I don't feel like this environment, implies that that's going to be in place for a longer period of time, but I could be wrong. However, I think what you want to do is try to separate noise, right? Normal fluctuation, sort of instant reaction to headlines versus a larger structural change. And that's where looking at leadership trends, looking at breadth, looking at momentum can help you maybe qualify. If we get a pullback, is that just a brief pullback, or is it something different? Let's see what kind of stocks and movements we get underneath the hood. But for now, I would say the S&P remains in a primary uptrend. My market trend model, as you may or may not remember, bullish on all time frames, as it has been here for about 4 weeks now, 6 weeks. So overall, pretty consistent. All right, while the S&P has been trending higher, sentiment data, let's take a look there. The AAII survey, this is a weekly survey of individual investors. It's reported on Thursday. So I find the Thursday show is a great time to review that. You can see an increase in bullishness. That's the green histogram in the upper right, up to 37%. A decrease in bears from over 40% down today down to 34%. And then the spread from bulls to bears back to net bullish. That happened a couple weeks ago, 3 weeks ago. We actually had bulls outnumbering bears for the first time since January. We are back above there, just a 3% spread between the two. So it's not by much. It's really more of a balanced survey, I would say, between bulls and bears. And remember, there's a whole group of investors that are neutral that I'm not showing here. That's is that third bucket. For now, so I would say the AAII survey kind of neutral, right? Sort of mixed evenly between bulls and bears. There's always that percentage of respondents who are always bullish in this survey. There's also a percentage that seem to be always bearish, at least is what I would assume looking at the data. So it's the swing votes in the middle, and I would say the swing votes are kind of evenly balanced between those two. We'll keep an eye on that for sure in the days in the weeks to come. The name exposure index, not much to report here for the last 6 weeks, with 1 week off where it went down to 70%. The rest of the time from kind of late April now to mid-June, it's been right around 83%. That's almost exactly the average reading, maybe slightly above average that I've seen looking at this data for quite some time. But overall, I would say no significant change. That tells you that money managers are sort of positioned in a normal allocation and waiting for more evidence to make some changes. I mentioned in my interview with Jay Hatfield earlier today, and again, that podcast should be out hopefully tomorrow morning. But we talked about interest rates, talked about the Fed, talked about a potential first rate cut, what that might look like, and a lot more that I'll let Jay explain his thinking along those lines. As a technical analyst, I like to draw lines on the charts and define the trends and identify when the trends are changing. I think what we've seen in the 10-year yield over the last week or two certainly implies that the dynamics of the bond markets are starting to shift a little bit from weaker bond prices off of the April market low, which is in this case shown by higher 10-year yields, to all of a sudden bond prices starting to improve, which means rates are coming down here. We're testing the 50-day moving average, so that's something I would be watching here after today's gap lower. Yesterday we had what's called a bearish engulfing pattern, where the day two engulfed day one's body. So not surprised to get a bit of a drop in rates today. I think rates dropping from here, probably not a great sign. That would imply a lack of optimism for economic growth, a flight to safety, for lack of a better term, to U.S. debt. We'll see if that trend persists. But for now, I would say the trend has changed from being a clear uptrend phase, which is what we saw in mid to late May, to now maybe at best a consolidation phase, and at worst the beginning of a further pullback in rates. And again, I don't think that's going to bode well for equities if that plays out. Looking at some individual stocks and ETFs, Oracle, the big winner today, up 13%. Nice earnings release. That was yesterday. Nice upside follow through today, opening around 190, getting another 10 points into the closing just below $200 a share to make a new 52-week high. The relative strength is strong. The momentum is strong. This is a good chart. Now, what's interesting is the chart was quite strong going into this week's release. The gap higher today is pretty encouraging as well. Now the question is, do we sustain this breakout? And if I hold Oracle here, I don't necessarily see on this chart a reason I would be selling that position today, but I'd certainly be watching it to see if this gap holds. And the moment you have a big gap like that after an extended run, that gap should immediately, in my opinion, become support. This is why it worked really well back here, right? You have the gap higher. If you get a pullback, do we hold the gap? And if so, that means that buyers are pretty happy coming in around 155. And now I can see that that's a pretty consistent pattern. That's pretty bullish. If we would gap higher and then fail into that gap range, that's where I would probably start to get a little more cautious and probably take some off the table because it shows you that maybe that gap is not going to hold. And maybe investors are thrilled to cash out after this, revaluation up 20 odd points from one day to the next. But a nice upside move in Oracle, however you think about it. Others within the technology sector, I'd highlight Arista Networks actively testing the 200-day moving average. A lot of things like Meta and others blew through their 200-day and have not really looked back. Others are struggling, like Apple, to regain their 200-day. And then you have these names like Arista, like Amazon, like Alphabet, that are actively testing their 200-day moving average. And I think of these as kind of the swing votes, right? You have stocks that are in clear uptrends. You have stocks that are clearly not in uptrends. And then you have these kind of question mark sideways charts that could regain their 200-day. And if charts like this kind of make headway above the 200-day, I think that's a good sign for the stock, but also a good sign for the broader market if names like this can get above the 200-day. Also, I'm watching $100 a share, big round number. That's often where stocks will find resistance just above current levels. I was looking at some charts earlier and found the Esports ETF, ESPO. Did you know, because I didn't, that ETF's up 25+% year to date, Esports. The S&P 500, by the way, is up 3.3% year to date. The NASDAQ 100 is up 4.5%. So talk about crap. I mean, when you look at this, I immediately think, is that gold? Like, what is that that's done so well? It's gaming and esports. Now, ESPO, ETFs like that, I would always encourage you, don't read too much into the name of the ETF and then make assumptions about what stocks are being held. I use a platform called Koifin, which allows you to dig into ETF holdings. You type in an ETF and you find the holders of it immediately, which I'm a huge fan of. The two biggest holdings in that ETF, by the way, because I checked before we started the show, Roblox is number 2, less than 10%, but certainly one of the top positions in the portfolio, maybe 7-8%, I want to say. Making a new 52-week high, new all-time high today, closed around 95. But in a pretty consistent uptrend. Extremely overbought earlier this month. We would always call that the good overbought. More than often, when you get an extreme overbought condition with an RSI above 80, you usually have at least one more push higher. And that's maybe what I'm looking at here. This is the kind of chart where if you completely miss the move, it's hard to add to something like this today when it's already had the run it has and it's already so overbought. That's why pullbacks are heavily anticipated. That's why pullbacks are often bought. And it usually doesn't make it down to the 50-day moving average before people start to get into it. But I mean, a parabolic move from $50 to almost $100 is almost a double off of the April low. So that's a long way up if you miss the move off the beginning. Now, the top holding in that ETF, by the way, is AppLovin, which personally seems like the most frothy name of a company ever. It just seems like the kind of it just takes me back to 2000 tech bubble kind of name, anything.com, which were like these beautiful stocks in the late 90s and they got absolutely clobbered. And that's when I was learning technical analysis, watching .coms just get absolutely crumble on the charts. So I'm just still affected by that 25 years ago in my process here today. But regardless of what it's called, the chart of AppLovin, not as extended, pulling back off an overbought condition. This is the kind of chart above 2 upward sloping moving averages, maybe a pullback to an ascending 50-day is an opportunity to buy on the dips. That's kind of how I would think of this generally in terms of structure. So those are the two biggest names. I've obviously had pretty good runs off of the April lows. This is one that went from $200 a share on April 7th to $425 a share earlier this month. So significant run. This is why that ETF has done so incredibly well. These are the two biggest holdings. Now, they probably didn't start that way. They probably became bigger and bigger holdings as the stocks appreciated. But for what it's worth, that's where the returns have come from. Those aren't the only things doing well and having pretty good runs. Newmont Corporation, which is one of the gold stocks and the only gold name in the S&P 500, and one that many follow. Though there are a lot of other gold stocks to look at for sure. The GDX is a good ETF that I like to use to sort of look at gold stocks as a group. But Newmont Mining in particular having a nice gap higher today after the latest pullback to the 50-day moving average. We can see 1, 2, 3, 4 pullbacks to the 50 days since the end of last year. Every one of those has ended up resolving higher. This price, the trend in gold overall has been pretty good. I would say from the chart of Newmont Mining, it's certainly looking like a cup and handle pattern, which is engaged if and when we break above the rim of that cup, which things I would say Newmont has to get above 558 to complete that rotation higher. But overall, pretty compelling setup here with decent momentum. Two more. I wrote an article for CNBC Pro earlier today. So if you follow my work there, check out my latest article on Starbucks. I feel like as a Seattleite, I'm contractually required to write about Starbucks at least once a quarter. That's not true, but I feel like it to spread the good word of coffee joy to all of us. But I would say from a technical perspective, fantastic rally to the 200-day moving average. I'm a little skeptical. I think we're in pullback mode here as we test the 200-day from below. Today, a bearish inside day is what it's called. We have a big up day and a smaller down day after becoming almost overbought yesterday on that rally higher. Wouldn't be surprised if we get a bit of a pullback here. The weekly chart is what's most impressive there, with a PPO buy signal on the weekly chart over the last week or two. Cardinal Health, CAH. If someone tells you healthcare is horrible, which I often have said some version of that, which I stand by. But if someone tells you because the sector is weak, you should avoid all healthcare names, I think that is a very dangerous thing to say, and certainly not a well-informed comment. Just because a sector does not score well, if you're thinking about sector allocation, I'm thinking of energy, healthcare, consumer staples, there are often names in those underloved, undervalued sectors that are actually doing quite well. Within energy, it's been like pipeline names and natural gas companies. Within healthcare, it's been like supplies or equipment. Charts like CAH, even though a lot of pharmaceutical names have been in primary downtrends for the last 12 months, here's CAH killing it in 2025. So I would encourage you, as a final thought here before we get to some questions, don't write off a whole sector just because the sector as a whole looks weak. That should help you think about allocation maybe, or rotation in a sector strategy. But in terms of stock picking, you will often find great charts in sectors you don't think should look as good as they do. That's why I sign off the show. It's always a good time to own good charts. Don't write off an underloved sector. All right, I see some great comments about the roosters, my bobcat, my facial hair. I appreciate you guys staying on task as always. The peanut gallery lighting up on all those things. Roosters are alive and well. We fed them earlier today. They're ours now. They have names. I won't be surprised if I show up one day and my family's created a house for them, to be sure. All right, let's take a question or two and we'll call it an evening, guys. 3P Investor, thanks as always for watching and for asking some really thoughtful questions. I think everyone benefits from people like you asking great questions every day. Thanks for that. Dave, I see you compare Gilead and SPY on your charts. Is it not appropriate to compare that with either IBB or XLV, interest sector, as opposed to the whole market? That is a brilliant question. And the answer is for sure, right? I think the way that I think of charts, and if you've watched any of my discussions with Grayson Rose, since I'm here at the Stock Charts office, we did our top 10 charts to watch for June a couple weeks ago. We've done that episode pretty much every month for a while now. Just got back to it a couple months ago after Grayson was on parental leave. But as we're looking at it, if you look at Grayson's process, what he talked about is you have sort of like your initial assessment, right? If you're bringing up a stock for the first time, I always kind of start, and sorry, you're asking about one of the healthcare stocks. I'll bring up Amgen, but it doesn't matter. Any of these names, right? If you're looking at Amgen or Gilead or any of the biotechnology stocks, my starting point, right? My initial kind of default view is this one, looking at a 2-year daily chart with these moving averages, looking at RSI as a measure of price momentum, looking at relative strength to see how this stock is doing versus the benchmark. Because generally, I'm a fan of owning things where this line is going up, because that tells me I'm outperforming the benchmark by owning that stock. I generally don't want to be owning names where the relative strength line is trending down, because that tells me I'm doing worse than the benchmark by owning that stock. I'm underperforming the S&P by holding that stock at that particular time. So generally, I want to find things where the relative strength line is improving. That's why it's part of some of the scans that I run. That's why it's at the bottom of most charts I look at, just to make sure I validate that. Now, if I really want to evaluate a stock like Amgen and understand the nuances, we probably want to go further, right? And I would say part of that due diligence of understanding a little deeply about, all right, if this looks like a good opportunity, where is that performance coming from? Or is it just a group thing? Are all biotech stocks up? Is it the healthcare sector is doing well? I probably know offhand that's not, but it might be, if I'm looking at some random chart. So two things you can do, right? I would tell you that the denominator most of the time should be kind of your benchmark. If you don't have a good benchmark in mind, I would use the SPY. Grayson swears by the VTI, which is a broad equity index. I think as long as you have something down there that's consistent, that's meaningful for you, I think you're generally going to be in the right place. And the reason why I would say this, if you were running a small cap portfolio and you wanted to do better than the Russell 2000, I would make the Russell 2000 your benchmark, because you want to own things that are doing better than that. Now, having said that, on the stock charts platform, the tool you use, it's called price dash performance. And then this is the syntax. $ symbol means whatever symbol I bring up this chart for, it's going to put that there. And then SPY is going to be the denominator. But I could also put sector, which means if I bring up, Amgen or Biogen or whatever, it's going to be relative to the XLV. I could do the industry, which means it's going to be relative to the Dow Industry Group. If I'm going to look at a lot of biotechs, I could put IBB and just relative to a biotech ETF. And it's not that any of those are right or wrong necessarily. It just depends on what kind of question you're trying to ask at that particular moment. And I would tell you what I would do, besides trying to just, move that sort of stuff around, set up a chart. And this is one that Gaddis Rose, Grayson's father, shared with me years ago, where he had a series of relative strength charts or panels for a given stock. So when you bring up Amgen, it's Amgen versus the benchmark. It's the healthcare sector versus the benchmark. It's biotech versus healthcare. It's the stock Amgen versus biotech. So by looking at each of those series, you can start to piece together, all right, is this a sector story? Okay, maybe not. All right, was it biotech? All right, biotech's doing pretty well. Is this one of the better biotech names? And by looking at the trends in those lines, you can start to understand a little bit further. So if you want to go back someday and hit pause and see how you set that up, this is the methodology used. It's just using $ symbol, sector, industry, and using different combinations of that with a benchmark to look at those panels. I think that's a really good way of really understanding the relative strength stories, and not just versus the benchmark, but to your point, looking at some other things as well. Boy, that'll do it for today, Ghost. That was a longer answer to the question, but I appreciate it so much. Some questions I didn't get to, I will put those in the mailbag. We'll be planning an all mailbag episode tomorrow. Again, appreciate your flexibility over the next week. I'm actually going to be flying to Boston tomorrow. I'm at a music camp for adults all next week. I'm bringing a trumpet, bringing my voice, going to be out in the woods of New Hampshire, up in the hills with a bunch of composers and performers. And we're going to play around and be creative. And I'm going to sort of scratch that itch in my brain as a former music major that is often dormant in my current professional life, but we'll enjoy doing that. Thanks for being flexible next week. Probably going to be doing a brief market recap every evening, time permitting, but I'll keep you updated as I do so. But in the meantime, thanks so much for tuning in today. Have a great evening. And remember, it's always a good time to own good charts. Take care, folks.